Let me start off by just getting your initial thoughts on that decision from OPEC. Was it a political statement or was that a statement of economic reality?
Yeah, no, it was a political statement, and it's a statement that they've sustained for the last few months. 3 months ago, turning back, they would have said, hey, we're the central bank of the oil market. We're going to be providing liquidity when it needs it. We're going to be withdrawing liquidity when it needs it. And now all of a sudden the argument is we're the regulator, and the regulator is doing something to stem volatility. Actually, they're increasing volatility by what they're doing. So it's a combination of really funny factors. The funniest of which, in a way, is that they did what the U.S. and Japan and China and India did not want them to do. They held steady on the output, and the prices went down, not up.
And Ed, what does this mean when it comes to first of all, demand? When do you expect demand to actually start peaking, and what does that mean for the price of oil?
Well, it depends on what you mean by peaking. So, OPEC has said that, and this was a precursor to the decision of this week. Last week, they said that demand was going to be very slow in growing. We've got the pandemic ahead of us. Actually, the reverse is probably more true. We're seeing an uptick in demand, and particularly an uptick in air travel, particularly starting in November. You just have to look at what airlines have scheduled that they were not scheduling in October. And the recovery from the pandemic has been quite robust. We actually think that demand has been on a par with GDP growth, about 1-to-1. We think it'll be a little bit lower next year, but still pretty high in terms of history. Demand is not really the ultimate issue. The ultimate issue in the longer run might be demand, but the ultimate issue in the short run is where that balance between supply and demand is. And the world is really drawing down inventories, and they're at a very low level, and we expect prices to continue to rise in the fourth quarter to get to a high level after whatever the financial sector has done to have this sell-off right now.
Ed, so your outlook then on prices, and also part of, I guess, that projection, I also wanted to get your thoughts on if we do get to a point where the world needs more oil, can OPEC Plus, or does OPEC Plus have that capacity to get that oil to the market equitably across their members?
Well, it depends on what you mean by equitably. The majority of the members can't meet their quota. They've lost their production capacity. They haven't invested. There are just a few countries that can expand, but they can expand a lot. They include Saudi Arabia, UAE, Kuwait, Russia. They all have an ability not to grow by 5 million barrels a day overnight, but certainly in the 3 to 3.5 million barrel a day range. And we think next year is going to be a very big surprise upward in terms of non-OPEC production, including from the U.S. I mean, the OPEC has been, in many ways, given this position by the very sharp decline in U.S. drilling and the sharp decline in U.S. production. But U.S. production is ramping up, and it's going to be bigger in terms of growth next year than anything we think we're going to see from any individual OPEC country.
Wow.
And it brings the next question, what the U.S. can do, because they did talk a little bit more about how the consequences of OPEC not ramping up output could lead to big implications for the global economy. But I have to wonder, in terms of the U.S. perspective, there's a likelihood now of them tapping into their oil stocks. How likely is that? And what sort of precedent does that suggest that it's going to have? It could actually have a bad precedent.
I'm not sure what kind of precedent it sets. There have been Republican and Democratic administrations in many autumn periods of time that gasoline prices were rising, and they said it's OPEC's responsibility to put more oil in the market. This is an embarrassing moment for the U.S. government. The U.S. government, under the Biden administration, which has been not looking at fossil fuels. We've had the U.S. production falling from a peak of 13 million barrels a day, gone down. But if we look at what's really happening right now, Permian, the biggest area of shale production in the U.S., has gone back to pre-pandemic levels. It's producing as much as it ever has. And we think it's on the verge of a big explosion, for lack of a better word, on production going into next year. So we think while the U.S. production went from a peak of 13 million barrels a day, just crude oil, if you exclude natural gas liquids and a bunch of other things, down to below 11 at one period of time. They're back at 11.5, 11.6 million barrels a day. And we think year on year, liquids production is going to grow by 1.4 million barrels a day at a minimum next year. That'll be the largest slug of things of all producers in the world. And ironically, I think if we look forward to a year from now, the issue is going to be what OPEC is going to do. And is it going to be restraining production again to fight what might otherwise be a $20 lower price?
It brings to mind also, obviously, with COP26 and the reminder that maybe we hadn't invested enough in oil, or maybe we shifted away too quickly without really a sort of reliable plan B. Ed, I mean, we're just getting some lines out of Indonesia. They're coming out with their GDP numbers, and they are talking about the global recovery and commodity prices going into that number. I'm wondering then, as we almost close out a banner year, not just for oil, but energy producers in general, where do you think they're going to use all that profit? And what sort of capex do you think we're going to see these next 5 years, Ed?
Well, so you've touched on a bunch of interesting topics. One of them is the energy transition. And certainly this has been, one of the things that Prince Abdulaziz bin Salman said in that statement that you had an excerpt of. One of the things he said was, this is not our problem, this is theirs in the making. The Russians have that same view. The Russians have their biggest gas and oil market in Europe, and Europe has sworn off of fossil fuels. And who are these people, they think? Who are these people to complain about there being tight markets when they're the ones who have gotten rid of their ability to use fossil fuels in power generation? They're the ones who are saying we've got to get off of this. So there is, a tension built in here between the producers of oil and gas and the biggest importers of oil and gas, and the movement at COP26 right now, where the energy transition has been a fairly critical issue. Now, the other question you raised is what are companies going to do about the profits they're now having? And you didn't say it exactly, but oil was at the bottom of the S&P 500 a year ago, and now it's risen higher than any other sector in the S&P 500. Oil is the darling of the investment community, despite what people are saying about anti-fossil fuel movement. What are they going to do with this? So certainly they're going to retire debt. Certainly the bigger the company that there is, they're going to be returning profits to shareholders. The smaller the company that it is, they're more likely to plow this back into investment. We've seen companies in the U.S. that have been, quote, disciplined. The discipline is that they have maintained 50% of their cash flow going into capital spending, but their cash flow is more than double. So their capital spending is more than double. They haven't done it maybe by all of them increasing their drilling activity, but they're buying other companies. And those other companies are really ripe for increased drilling, which is why we're thinking about oil production out of the U.S., out of Canada, out of Brazil, being pretty robust next year.
And I was going to ask you about China. The power shortages seem to have eased somewhat there. What impact do you think that's going to have on energy prices?
It's had an impact. So if we look at what's driving most of the energy price increase, is power generation. And the world got cut short probably by weather conditions in the Northern Hemisphere over the summertime, including in China, which had a combination of drought and a lot of rainfall. All of the major consuming countries in the Northern Hemisphere, China, the US, Canada, and Europe, have had drought conditions, so that hydropower really sunk to very low levels. They all had very high temperatures, actually record temperatures over the summertime, and air conditioning demand, electricity demand in general was at record levels. So there was not an ability to store natural gas and other fossil fuels needed, and there was a lack of, ironically, in the middle of COP26, solar and wind in various parts of the world. So it really was a crisis of the energy transition, and countries, including China, went into the autumn with very low level of inventories. What Chinese have done is very anti-COP26, but very much in what they're capable of doing. They started mining coal, and they're now mining coal to beat the ban. They're adding like 2 million tons a day to their inventory, and coal, which went up 300%, has fallen by 55% in a 2-week period of time. And as that falls, natural gas falls on a competitive marketplace. And then the edge on the oil side, one of the reasons oil has actually gone down is because all of these other fuels for power gen has gone down, and the switching from coal or natural gas to oil has stopped also.